86 million ounces. That is all that is left. That is the entire registered silver inventory on the COMEX right now, the metal that is actually available right now for delivery to anyone who holds a futures contract and says, give me the real thing. 86 million ounces. And here's the part that kept me up last night. Nearly 60% of that pile is already spoken for in March delivery notices. Before Monday's open, right now, this weekend. If you hold physical silver or you are thinking about it, what I am about to show you in this video is the most important price data you have seen in months. Stay with me. Last week, the one thing I told you to watch was dollar index positioning around the 99 level and whether silver could hold its ground even if the dollar strengthened. I said that if silver was still climbing with DXY above 99, that would be a significant tell, because it would mean the move was being driven by something other than dollar weakness. The dollar is now sitting at 98.99, and silver is not just holding, it is running. That call landed. What it means for this week is exactly what this video is about. My name is John. I spent 15 years working inside currency and commodity markets before I started making these videos. I have been in rooms where the mechanics of exactly this kind of setup, paper price diverging from physical price, get discussed calmly by people whose names you would recognize. And I started Currency Insider because I believe the person sitting at home watching their stack deserves the same level of analysis those rooms were getting. That is what we do here. Everything I show you today comes from publicly available sources, and I will name everyone as we go. 3 things you are going to understand by the end of this video. First, what this Shanghai premium actually means and what it does not mean, because the nuance here matters enormously. Second, the mechanics of how a paper and physical price gap like this one historically resolves. And third, one specific thing I am watching this week that will tell us whether this is a genuine structural break or a temporary arbitrage that fades quietly by Wednesday. If that kind of calm, data-first breakdown is what you have been looking for, hit the like button right now. It tells me to keep making these. And if you are not subscribed yet, this video is part of a bigger picture we are building week by week. Now is the time. Let me give you the price context first, so we are all starting from the same place. As of Sunday, March 8th, silver in New York, the COMEX front month, is sitting at roughly $83 per ounce. Now pull up the Shanghai Futures Exchange and the same metal is trading at $96.53. That is an $11.53 gap, 13.5%. Think about what that means in plain English. The same physical commodity, silver, is being priced 13.5% higher in Asia than it is in New York on the same day. Now, before we go any further, I want to be precise about something because this is where a lot of channels either mislead you accidentally or mislead you on purpose. Premiums between markets are not always a pure scarcity signal. They can reflect local taxes, currency controls, financing costs, and the structural quirks of how each exchange is set up. I am going to come back to that. But even after you apply every reasonable haircut to this number, $11 of premium with 60% of deliverable COMEX inventory already claimed is not noise. That combination is a signal worth understanding. And the question I want to answer today is what kind of signal it actually is. Before that, quick question I genuinely want you to answer in the comments right now. Are you seeing elevated premiums at your local coin dealer or bullion supplier this week, or have physical premiums normalized where you are? Drop your location and what you are seeing. The comment section here becomes a real-time sentiment tracker, and I read every single one. So let us start with the COMEX inventory situation because this is the foundation of everything else. The CME publishes a daily warehouse report. It is public, it is free. You can find it through the CME Group's data tools. What that report showed heading into this weekend is registered silver inventory at 86.1 million ounces. Now to give that number context, registered inventory is not the same as eligible inventory. Eligible silver is metal sitting in COMEX-approved vaults that could theoretically be converted to registered, but has not been formally made available for delivery. Registered is the stuff that is actually on offer, the metal with a for sale sign on it. A year ago, registered inventory was sitting comfortably above 150 million ounces. The drain from that level to 86 million in roughly 12 months is the kind of structural shift I have only seen a handful of times. Now here's where it gets genuinely interesting. The March delivery notices that have already been filed represent close to 60% of that registered pile. Think about what that means mechanically. If every entity that filed a March delivery notice actually takes delivery, actually shows up, and says, "Give me the metal," you are left with just over 30 million ounces of registered silver to cover everything else the market needs to function. That is not a comfortable margin. That is a system running thin. Think of it like a hardware store that has 100 boxes of a specific part on the shelf. 60 of those boxes have already got sticky notes on them from customers who called ahead. The shelf looks full. But it is not. And if 3 large contractors walk in on Monday morning and want 10 boxes each, the maths gets very uncomfortable very quickly. That is where the COMEX is right now. Now here is the part where I want to be honest with you, because intellectual honesty is the only reason to watch this channel. Not all delivery notices get taken to physical delivery. Some get rolled, some get cash settled. The system has pressure release valves. History shows that registered inventory has been this tight before without triggering a full cash for delivery crisis. I am not telling you Monday is the day the whole thing breaks. I am telling you the conditions right now mean the system has much less room to absorb unexpected demand than it did 12 months ago. That distinction matters enormously. Now let us talk about Shanghai, because this is the number that has been genuinely moving conversations in the professional space this past week. If you know someone who has been trying to make sense of these silver moves this week, share this video with them right now. Seriously, this breakdown took time to put together, and the people who need it most are probably not searching for it. The Shanghai Futures Exchange, the SHFE, is China's primary commodities exchange. It is not a fringe market. It is enormous. It is liquid. And it is where physical silver demand from China's industrial sector gets priced in real time. When Shanghai silver trades at a premium over New York, the traditional interpretation is that physical demand in Asia is strong enough that buyers there are willing to pay more to secure metal. A 13.5% premium is not a small adjustment. To put it in terms that make it tangible, if you are a large industrial buyer in China, a solar panel manufacturer, an electronics company, someone who needs actual physical silver to make actual physical products, you are currently paying 13.5% more than the headline COMEX price suggests you should have to pay. That is an enormous operational cost. It tells you something about how hard it is to source physical metal in that market right now. Now, and I want to be careful here, I said earlier that premiums can reflect factors other than pure scarcity. In China's case, the SHFE has its own import mechanics, its own VAT structure, its own financing ecosystem. Some portion of this premium is always going to be structural, but $11? In a market where historically a $2 or $3 premium is considered elevated. Even after you account for the structural component, you are left with a genuine supply tension signal. And here is the geopolitical layer that makes this more interesting. The DXY, the dollar index, is sitting at 98.99. In a normal cycle, silver running hard would be partly explained by a weak dollar. Inverse relationship. Dollar down, commodities up. But the dollar has not collapsed. It is not screaming weakness. Silver is moving anyway. What that tells a 15-year market professional is that this is not purely a currency play. The physical market is generating its own price pressure independent of what the dollar is doing. That is a qualitatively different kind of move. It is also the kind of move that tends to be stickier, because you cannot solve a physical supply problem just by changing interest rate expectations. Now I want to talk about positioning, specifically what the large institutional players are reportedly doing, because this is where the paper and physical story starts to connect. The Commitment of Traders report published by the CFTC gives us a window into how managed money and commercial participants are positioned in silver futures. What the most recent data shows is that some of the larger bullion banks, the entities that have historically been net short silver futures as part of their hedging and market-making operations, are in a complicated spot. When physical demand unexpectedly accelerates the way we are seeing in Shanghai, short positions in the paper market become more exposed. The arbitrage gap between New York and Shanghai creates a natural economic incentive for anyone with access to COMEX silver to pull it out of the registered inventory, ship it east, and capture that 13.5% premium. And that drain is exactly what we are watching happen in real time. De-dollarization as a structural backdrop, and I want to be clear, this is a decade-long process, not a Tuesday event, means central banks in the East have been systematically accumulating gold and real assets. The World Gold Council documented another significant quarter of central bank buying in their most recent published data. These are not traders. They do not check price charts every morning. When a central bank reallocates reserves into hard assets, that is a multi-year institutional decision. The directional travel is documented even if the timing is uncertain. For the UK viewers watching, This is equally relevant across the Atlantic. The London Bullion Market Association, the LBMA, is the world's primary over-the-counter gold and silver trading hub. LBMA vault activity and lease rate data are worth watching alongside COMEX because London is where a significant portion of large-scale physical settlement happens. Any tightening in LBMA lease rates for silver, the cost of borrowing physical metal, would be a corroborating signal for what we are seeing in New York and Shanghai simultaneously. Quick second question I want you to answer in the comments. And this one is more analytical. Based on what you have just heard about the SHFE premium and the COMEX inventory drain, which do you think resolves first? Western prices spike upward to close the gap, or Shanghai premiums compress downward as import flows normalize? Tell me your thinking. I genuinely want to know. Let me talk about industrial demand for a moment because it is the context that makes the Shanghai number make sense. Silver is not like oil where you can watch it burning. It is hidden inside electronics, solar cells, medical devices, EV charging components, connectors that carry current in the AI hardware build-out happening right now at a scale most people have not fully registered. The Silver Institute, which publishes the most comprehensive annual demand survey in the industry, has documented consecutive years of structural physical deficit, meaning the world is consuming more silver than it mines and recycles. Now, I am not going to give you a precise ounce per megawatt figure for solar because that would be false precision and you deserve better than that. But the directional picture from the Silver Institute's data is that photovoltaic demand alone has more than doubled over the last 4 years. Thrifting, manufacturers using less silver per unit as prices rise, is real, and it partially offsets the scale effect. But at the volumes of solar being installed globally right now, even a thrifted panel still needs silver. The North Sea energy transition in the UK and the broader European renewables build-out are part of the same structural demand picture. This is not abstract. This is physical metal being locked into infrastructure that will last decades. What this means for today's story is that the industrial buyer in Shanghai is not a speculator. They are not buying silver because they think the price is going up. They are buying silver because they need it to make something. That kind of demand does not evaporate when sentiment shifts. It compounds. All right, let me show you how I am actually thinking about this week using the 3 lanes framework. This is how I separate what is noise from what actually matters. Lane 1 is the paper market, futures, positioning, the COMEX mechanics. Right now, the paper lane is telling us that registered inventory has hit 86 million ounces, with 60% already allocated to March delivery. That is a structural tightness reading. The CFTC COT data shows commercial short positioning in a complicated spot given the physical drain. The paper lane is flashing amber. Lane 2 is the physical market, Shanghai at a 13.5% premium over New York. COMEX registered inventory declining over a sustained 12-month period. If your local dealer is telling you premiums are elevated, and I want to hear that in the comments, that is a ground-level confirmation of what the wholesale data is showing. The physical lane is flashing red. Lane 3 is macro, rates, dollar, geopolitics. DXY at 98.99. Silver rising without dollar weakness. Central bank accumulation continuing as a documented multi-year trend. Fiscal pressures in both the US and UK that make hard asset allocation a rational portfolio response for serious investors. The macro lane is flashing amber to red. In 15 years watching currency and commodity markets, the times I have seen all 3 lanes signal in the same direction simultaneously, even briefly, have historically been some of the most significant moments in these markets. I am not saying we are there today. I am saying the configuration right now is one where all 3 lanes are pointing the same direction. When the paper lane is showing inventory stress while the physical lane is showing a 13% geographic price gap, and the macro lane is showing a currency that cannot explain the move on its own, the historical pattern has been that the price gap closes upward, not downward. That is a framework, not a forecast. You decide what to do with it. Here is the one thing I am personally watching this week. One thing. Monday's open and the first 2 days of COMEX trading. Specifically, I am watching whether we see a meaningful increase in cash for delivery notices versus roll activity as March futures approach expiration. The CME publishes first notice day data, and I will be checking it the moment it is available. If we see a significant percentage of open March contracts elect physical delivery rather than rolling to May, and if that delivery demand runs into the registered inventory constraint we just talked about, the mechanism for a rapid spot price adjustment is in place. The threshold I am watching is this. If registered inventory drops below 75 million ounces before March expiration, while the Shanghai premium holds above $8. That combination would be a historically significant setup. If instead the March contracts roll cleanly, premiums in Shanghai begin to compress, and registered inventory stabilizes, it tells us the system found its pressure release valve, and this week becomes a reset rather than a break. Both outcomes are worth knowing in advance, so you are not reacting with emotion when one of them develops. This is my one call for the week. John FX Insider, on record. I will be back next video to tell you exactly what happened. No edits, no excuses. That is the only way this works. Now here is where I want to be completely straight with you, because this is where most channels pick a side and run with it. I am not doing that. Here is what needs to happen for the optimistic picture to develop. March delivery notices have to translate into actual physical takedown at a rate that overwhelms the system's ability to settle. The Shanghai premium has to hold or widen, confirming that the Eastern physical bid is structural and not just a short-term financing artifact. And macro conditions, particularly the dollar staying range-bound or weakening, have to avoid giving the short side a fundamental reason to press. If those three things align, the path toward $90 and above in New York spot becomes a live scenario. Here is what needs to happen for the cautious picture instead. The CME raises margin requirements, which it has done before and can do again with very little notice, and that forces leveraged long positions to liquidate regardless of the underlying fundamentals. When margin goes up overnight, it is like a landlord suddenly tripling the deposit requirement. The tenant did not change their mind about the apartment. They just ran out of room. Forced selling into a rising premium environment has happened before, and it produces exactly the kind of sharp dip that shakes out retail holders right before the real move. The bearish scenario here is not that silver is fundamentally wrong. It is that the paper mechanics create a temporary flush before the physical reality reasserts. Both are genuinely possible right now. Your job is not to pick one and emotionally commit to it. Your job is to watch which conditions are actually developing. The market will tell you. You just have to be watching the right things when it does. Before we close, the disclaimer you need to hear, and I mean it. Everything in this video is educational content based on publicly available information. Currency Insider does not provide financial advice, investment advice, tax advice, or legal advice. Nothing here should be construed as a recommendation to buy, sell, or hold any asset. Past market behavior is not a guarantee of future results. Always consult a qualified financial professional before making investment decisions. Before the two questions, if you got value from this today, the like button takes 1 second and it genuinely helps this channel reach people who are trying to navigate these markets without all the noise. Hit it now. I want to ask you two things, and I genuinely want your answers, not just a thumbs up. First, are you currently holding physical silver, mining exposure, or both? And has what you heard today changed anything about how you are thinking about your position this week? Second, the 13.5% Shanghai premium. Do you read that as a genuine scarcity signal, a structural arbitrage that will close quietly, or something in between? Drop both answers below. The comment section here becomes a real-time sentiment tracker, and I read every single one. Subscribe because next week we are going into the mechanics of COMEX delivery and first notice day in detail. I am going to show you exactly how to read the CME warehouse report yourself so you never have to rely on anyone else's interpretation of it. That is a skill worth having. And if someone in your life is watching their stack right now and feeling confused about what is happening, share this with them. That is the whole point of this channel. This is Currency Insider. Know the market. Protect your currency. Your